Imagine, like, trying to herd 500 cats.
Oh, yeah. An absolute nightmare.
Right. It's chaotic, it's expensive, and it takes absolutely forever.
Exactly.
And that is exactly what buying all the individual stocks in the S&P 500 feels like for an active trader who just wants to, capture a sudden market swing.
Yeah, it's just not practical.
So today we are taking a deep dive into an Indices CFD trading guide for active traders. And the whole mission here is for you to understand how these traders capture massive macro shifts, like, say, a red-hot inflation print, without actually having to buy 500 individual stocks.
Right, because index CFDs basically let you bypass the cats entirely, and you just trade the direction of the stampede.
I love that. You aren't managing the animals, you're just getting in front of the herd. But okay, let's unpack this a bit. Since we're looking at the whole stampede, how exactly does this instrument work? Like, if I'm not actually buying the stocks, what exactly am I holding?
Well, you're holding a contract for difference, a CFD. It's a derivative. So when you trade an index CFD, you aren't actually taking ownership of any underlying shares. You are strictly trading the price difference between your entry point and your exit point.
Wait, really? So no actual ownership at all?
None at all. And because of that structure, your entire strategy completely shifts. You don't care about dividend payouts or shareholder rights or long-term custody. Your focus narrows entirely down to price action, margin, and timing.
But hold on, if I don't own the underlying asset, I'm not collecting dividends, I have no voting rights, I'm essentially just making a side bet on a price feed. Doesn't that sort of strip away the real benefits of investing?
It strips away traditional investing benefits, sure, but you gain the tactical agility that active traders really need. You actually get two massive draws here.
Okay, what are they?
First is frictionless short selling. If markets are tanking on, say, recession fears, you can position yourself for a downside move just as easily as buying.
Right, you don't have to borrow the shares first.
Exactly. And second, and honestly more importantly, is leverage. You can deploy just a fraction of the capital up front to get this broad market exposure.
Yeah, but the guide is pretty intense about how leverage should be handled. It's not free money.
Oh, absolutely not. Because it's the biggest trap in trading, hands down. Beginners see these lower margin requirements, and they treat them as a safety net.
Oh, wow, yeah.
But think about the actual math here. If you're only putting down, say, 5% of your own capital to hold a massive contract, a 5% drop against you doesn't just dent your portfolio. It entirely wipes out your initial margin.
Ouch.
Yeah, the guide has a great rule for this. If you treat leverage like extra room instead of extra risk, the market corrects your mistake by liquidating your account instantly.
Because you are playing with magnified stakes. So if leverage magnifies everything, what actually triggers these fast price moves to begin with?
Pure macro drivers. We're talking about massive economic data drops, like non-farm payroll, central bank data, or GDP releases. Like a surprise inflation number hits the wire, and it just triggers a massive repricing of the entire index in a matter of seconds. But, not all indices process that news the exact same way.
So are these indices like different vehicles? Like the US 500 is maybe a reliable, balanced sedan, while the tech-heavy NAS 100 is this momentum-driven sports car that just punishes poor timing?
Spot on. What's fascinating here is that the NAS 100 is hypersensitive to its biggest tech components, which creates, violent volatility.
Right. If NVIDIA sneezes, the whole index catches a cold.
Exactly. The US 500 is much more insulated by its diversity. But no matter which one you trade, timing dictates everything. Like for U.S. indices, the New York Open is just absolute chaos.
Because the market is suddenly reacting to all the overnight news at once.
Exactly. And because the repricing happens so fast, you literally can't be fighting your software. You need institutional-grade platforms with rapid execution speeds, like MT4, MT5, or cTrader, just to get your orders filled at the price you actually clicked.
Wow. Driving that sports car at the New York Open sounds pretty chaotic. How do traders actually survive that?
Through strict, almost robotic risk management. The guide outlines this golden rule, which is you have to calculate your position size based on where your stop loss needs to go, not where you hope the market will go.
Wait, meaning you look at the chart, find the technical level where your thesis is proven wrong, and then work backward.
Precisely. If placing your stop behind a major support level means risking more than your account limit allows, you don't widen your risk limit. You shrink the trade size or just skip the trade entirely.
Oh, that makes sense. It's math, not hope.
Right. You also have to keep a meticulous trading journal. Once you track your entries and emotions, you realize your results aren't random. And above all, remember that not every day is trend day. Sometimes the market is just chopping sideways, and the most profitable thing you can do is just stand aside.
Stand aside and do nothing. So to pull this all together for you listening, index CFDs offer this incredible flexibility for trading macro sentiment, but they absolutely demand strict risk control and patience.
They do.
Yeah.
And it raises a really fascinating question to leave you with. If trading index CFDs strips away company ownership entirely and focuses purely on price action, margins, and timing, does this mean modern active trading is less about business fundamentals and entirely about measuring human psychology?
Oh man, that really makes you rethink what you're looking at. You aren't analyzing the cats anymore, you're just measuring the fear and greed of the stampede.
Hmm.
Definitely something for you to think about the next time you pull up a chart.